Welcome back, everybody. It's another episode of Bold Real Estate Investing. I'm your co-host, Chris Angel, here with your host, as always, Bill Dean. Hello, Bill.
Hello. How are you doing?
I'm good. We're coming off an awesome episode on veteran real estate investing strategies. So good. If you guys didn't hear that, you got to go back. If you know anybody in your life that is a veteran or an active military, make sure they hear that episode because there's crazy opportunities that I think most people just don't know are there. So thanks for that, Bill. Today, we're talking about real estate. 2019, like a real estate investor forecast, what's happening in the markets and money and all that stuff. So teach me. Teach me, wise one.
Anytime we're forecasting, I mean, anything can change. So I do have to preface that this is just kind of a compilation of data from the National Association of Realtors to some of the economics guys I follow, and then just people on the ground investing across the country.
Perfect. Love it. Nice composite of data.
Yes. So it's not going to be like super scientific for this show, but it's just kind of what's happening out there.
Yeah, I love it. Yeah, keep it simple for me, Bill. But I want to hear because I do geek out on numbers a little bit when it comes to like forecasting. I like the idea that I could sort of look at what might happen.
Well, we'll kind of start with what the NAR put out there, the National Association of Realtors.
Yep.
And right now they're talking about we're having a pretty high mark in equity.
Okay.
So rewind 2008, 2009.
Yeah.
There was no equity. Bottom went up, everything went around. Like there was just people that were upside down in their house. They owed more.
Yeah, than they could sell it for. Right. Okay.
So now we've had almost 10 years of appreciation now.
Right.
Some markets are still double-digit appreciation.
Yeah.
So as a whole, like the National Association of Realtors is saying that it's going to keep going up.
Right.
There's nothing really to pull it down at this point. So
that's good because I think people have talked about, I've already heard the word bubble floating around again, like people afraid the bottom's going to fall out. Are we going to go through that again every 10 years, the market cycles? But according to NAR, you're saying that they don't think it's going to stop appreciating.
Yeah. So the public report, they're saying that it's probably going to keep going.
Okay.
Now the individual head of Fannie Mae has a little bit different outlook. He actually thinks that there will be a market correction, but it's not 2008 style where you're going to lose half the value of your house.
Right.
Might be a little bit smaller, like a smaller one, but just to kind of bring us back to course. But we're talking like single family housing because what's happening is with these high equity positions and with the stock market starting to jump and go up and down, and there's people talking about, hey, the form the market's making is either going to break up or break way down.
Right.
So when let's say you're 62 and you have 5 years left to retire, you probably don't want a market downturn because that could
in your stocks or in your real estate?
In your stocks, or just in your investments in general.
Okay.
So what's happening is a lot of investors are starting to pull money out of stock and put it other places.
Right.
One of their favorite ones is real estate.
Real estate. Yep.
So what's happening in a lot of primary markets, that would be like your LA, San Francisco's, New York's, Boston's. The prices are still climbing a little bit. Some of them are actually stopping or slowing.
Right. Yeah.
But the competition level is still there.
Meaning there's more houses on the market, or there's competitive buyers. There's not enough houses. It's small inventory.
Yep.
Got it. Okay.
Yeah, you can't really recreate New York because there's only so much island there.
Right. Yeah.
So what's happening is because those are still kind of way outside of the normal affordability of most people, they're starting to go out to the secondary markets, the smaller ones. So like Orlando's exploding and huge, but you can get safer, cheaper investments for a fifth the price in Jacksonville.
Got it. Okay.
As an example. So these secondary markets are starting to actually pick up steam.
Interesting.
So like Memphis, Tennessee, or another one I've been hearing about is Cleveland, Ohio.
Wow.
Like, could you imagine, hey, let's go invest in Cleveland?
Yeah, I know. I do like that about, like, this is why I like forecasting, because it's really interesting to see if you could get a head start on a developing area, I mean, and get in on a secondary market where it's about to appreciate, you could ride that momentum. That's why I like forecasting like this.
Oh, well, even I was just down in Arizona a few weeks ago, and some of the biggest buyers are from California because it is still so much cheaper to own property in Arizona than California.
Right. Yeah.
So yet again, there's lots of buyers, there's lots of job opportunity in California, but if you can work from home or, as that change, you can live elsewhere and work where you need to work.
Yeah.
Is
Bismarck a secondary market for like Minneapolis?
Not really.
Is it a secondary? Is it a primary market? It's its own thing.
It's too small. I mean, we are a tenth of the size of Minneapolis, St. Paul.
How many hours? Is it like 4?
6 hours.
6-hour drive?
Yeah.
Got it.
And that's fair weather.
Right. Yeah. Got it.
So, I mean, we're the boondocks as far as that goes.
Boondocks. Got it. Well, keep going on your forecast. What else are you seeing in the data for 2019?
So they're talking more interest rate hikes. So that actually fights with the value of homes.
Yep.
So every time the interest rates go up, the same income can afford less and less house.
Right.
So that's kind of going to have an interesting effect as well, because what's happening is because there is a lot of equity and a little bit of, and there's stock market volatility, there's more money competing for the same real estate.
Got it.
Because like if you knew there was a 120-plex you could invest in that even at 90% occupancy can still spit out $5,000 a month for you.
Right.
Well, there's institutions and other people who will buy that up to where it's only spitting out 2,000 because that's all they need.
Right. So it's more competitive for those opportunities.
Yes. So that's kind of the second big thing, is that the competition is much bigger now. And is that because they're trying to reposition their money out of the stock market and into something more stable like real estate? Yes. Got it. Yep. Okay. So I actually worked with an individual who was given $10 million to invest in homes in Kansas City and 3 other states, not big cities. I mean, Kansas City is large, but he's able to invest in these smaller markets at the time. Charlotte was one, but that one kind of exploded on him in a good way, but makes it harder to find rental properties when the values keep shooting up. Right. But yeah, so they gave him money and they said, hey, we just want a 3% ROI. Wow. So he was shooting for 15 plus 20, 30% ROIs. And now he has a buyer who's happy with 3%. So is it just because they're trying to park their money in there? Yeah. Is that, I mean, they're just like, hey, just put our money somewhere safe for a minute. And then when the stock market comes back, we'll push it back into the stocks or something like that. Yep. Interesting. Isn't that interesting? Wow. That's crazy. Wow. Well, it makes sense on a few levels because if they're making 1%, they can sell a part of that profit and it gets right. That's a whole different ball of wax. That's what's happening with some of the bigger areas because like, if you buy a resort in Orlando that's near Disney or Universal, you probably won't have a hard time filling it. If you buy a hotel in Bismarck, North Dakota 2 times a year, when it'll be full. Right. So interesting. State basketball and hockey. Right. That's great. Ice fishing season. Yeah. Well, even then it's the small towns. Yeah. Right. Wow. That's so great. What else are you seeing? What else are you noticing 2019 forecast wise? So some of the changes now. So we talked about how like to buy rental properties with existing homes, you have to kind of go further and further out. And that has its own little risk because kind of like the ripple effect. Yeah. The smaller areas will see the biggest price increase on an up market, but they also experience the fastest decrease. Got it. Right. So it's something to be kind of aware, like, does this area hold its own? Does it have the right type of jobs? Does it have enough of them? Or is it a one-trick pony and heaven forbid that main employer goes away, Right. are you left with empty houses? So
that's what happened, by the way, with the oil boom in the Dakotas, right? Where it was like people got in on that secondary market, things skyrocketed in appreciation, but then when it was done, like everything dropped. And
yeah,
right,
so
like that,
$2,400 a month rent dropped down to about $800.
Right.
So wow. Some people were smart with it and made all sorts of great money, and some people tried to, so it was going to stay like this and had to sell everything at a loss. So it's a little, it's tough, but you have to pay attention to what's going on on that, because so now in those bigger markets, and even some of those secondary ones where you have like the vacation opportunities, we have the big boomer wave coming. They're starting to retire more and more for the next 20 some years. That whole generation change. Right. Is be looking for places to vacation, places to winter if they're coming from the north, affordable housing. Right. So that's kind of changing the dynamics too. This year's gonna be more like last year as far as how that's all really gonna run, but it's something else to pay attention to, because now resorts and those type of things and trailer parks are gonna start growing in popularity, because I don't need, or they won't necessarily need, $1 million home when they're only gonna be there during the cold months. Right. Yeah, so that's good. Yeah, start planning. Maybe want to start investing down south if you're a northerner like me, and vice versa. Yeah. Because the last thing really with it is that new construction is starting to make sense in these bigger markets. So where the markets are hot, like where I live, rent is low enough that if you built a brand new house to rent it out, you'd lose money. Right. But in other markets like Dallas or pretty much along the coast in California or in Florida, you can build a house and you'll cash flow it renting it out. Wow. I know Jacksonville's got a lot of new construction. You said Jacksonville earlier. I know it's got a lot. There's, and I think some of that, isn't that some of that new construction bill from just because there's such low inventory, builders are trying to like build because there are more buyers than there are houses for sale. Yes. Yeah. So that is, we're even experiencing a flavor of that up here because there's no money in making affordable housing. There just really isn't. It takes the same amount of manpower to make a 2,000 square foot house as a 6,000 square foot house, except the 6,000 square foot house will sell for 1.2 million versus the 2,000 will sell for 200. So yes, you're putting more material, but if we take the time, the headache, the ordering of material, well, would you rather make 50,000 or would you rather make 200,000? Right. So they are making affordable housing. Don't just think that it's just millionaires building. They're making affordable developments, but in those higher income areas where there's a lot of pressure from retirees, from people just wanting to get away from cold weather, where there's tourist things to do, you can actually build to rent. So that's for people around my area, that's not common. Normally we're rehabbing older homes that, grandpa and grandma's old house. So we talked about that actually. This might be different than what you're saying. It was several episodes ago though. We talked about actually building a fourplex, building duplexes, like new construction stuff. But if you're talking like retire market, I'm not sure that somebody would want to live in a $1 million duplex. If I'm a retired boomer, I would imagine, but I don't know. I'm not a boomer. Well, there's a big mix. I mean, it all depends where and what, because like for friends of mine who invest in Arizona, they can make a killer in wintertime renting to snowbirds. But then in summer, they're going to make under a quarter of what they're making during the cold months. Right. And there's a strategy for that. And maybe it's kind of nice to know you can just seal up the house and leave it and come back. Right. So maybe if you like that traveler dream where, okay, I'm only here while it's busy, and then you go travel the world the rest of the time. Right. There you go. Huh. So it's just kind of watching like 2019, just kind of watching where money's going. I mean, if the stock market starts getting crazy, you're going to see people really pushing to get into real estate. And with the corporate money coming in, they don't need the same returns as you and I would, because our goal is hopefully at least every 7 years to be doubling what we have. So
versus they're just trying to park their money. They're just trying to, corporations or, corporate money is just trying to park it for a while.
Yep.
Yeah. Interesting. Anything else you want us to know about the forecast or the data that you've seen that you think would be helpful, insightful?
Well,
you've given us a lot. So,
well, for those individual investors like myself, and for those who are helping others, like I'm working with other investors even to find properties and projects. Don't give up hope, but network. Go talk to other people in this, because some people we all have different circles. We all have different networks. Just put the word out there, see what comes back, because you may never know when someone has a wholesaling ad out of one state, but they got someone in your state, but their friend is too busy to handle it. So, hey, here's a deal for you just because you asked the question.
Right. Yeah. So good.
What are you working on? You got anything else that, because the deals are still out there. A lot of people are going after foreclosures, and it's kind of the low-hanging fruit.
Right.
But, if you use some of our previous conversations about contract for deeds and doing some options, you can still
partnering with the VA.
Partnering with the VA, yes.
Go back to our last episode.
Yep. Building a good team. You can still find these deals because people are still getting divorced. They're still getting sick. They're still upgrading. They're still getting fired. I mean, life is still happening. So the deals are out there. Just be ready and keep an open eye.
It's really good. Well, and if we want to learn how to be ready by talking to you, right? Or we want to kind of get our ducks in a row to be ready, how do we reach out to you? How do we connect with you?
Yeah, so come to BillDeanHomes.com. So my name, homes.com. Perfect. And just click on the comments, start a chat with me, because there's a few things we can go over to really help set you up so that when that deal comes up and you know that there's probably going to be 3 or 4 of you looking at it, you can jump.
It's really good. And like I said last time in the last episode, it doesn't matter if you're in North Dakota or not. You can actually connect with Bill, and he can connect you with his network of realtors, lenders, people around the U.S. So no matter where you are, if you've connected with Bill somehow through these episodes, make sure you reach out to him. He can connect you no matter where you are. So, Bill, good stuff today. Thanks for your forecast, your interpretation of the data for 2019. I'll be interested to see how it plays out for sure.
Yeah, it'll be fun to see where we're sitting at next year.
I know, right? Exactly. Well, thanks for your time today, Bill. Take care. We'll see you next time.
Thank you.